A few weeks after taking delivery of his new car, Nand drove to the same cafe where he and Aviraj had spent several evenings discussing how to negotiate with dealers, compare quotations, and arrange the smartest financing. Inside the cafe, Aviraj was already waiting with 2 cups of coffee. "How's the car?" he asked. "It's been fantastic," Nand replied. "But something has been bothering me." Nand laughed. "Nothing's wrong with the car. I was just thinking, because of your advice, I spent much less than I had originally planned." He paused for a moment. "So now I have some money left." Aviraj smiled. "And what are you planning to do with it?"
Nand shrugged. "I don't know. Some friends are telling me to invest it in mutual funds. Others say I should buy gold. But these days, everyone seems to be talking about IPOs. They keep saying, apply in every IPO. Listing gains are almost guaranteed." Nand nodded. "So, before I invest even a single rupee, I should understand how IPOs actually work?" Aviraj smiled and said, "People often spend more time choosing a mobile phone than deciding whether to become a shareholder in a company." Nand nodded. "I know it stands for initial public offering, but beyond that, I'm not sure." "Good," Aviraj replied. "An IPO is the first time a private company offers its shares to the public. Until then, the company is usually owned by its founders, promoters, employees, and early investors."
"So what do I need before I can apply?" Aviraj held up 3 fingers. Only 3 essentials. First, a PAN. Second, a DMAT and trading account. Third, a bank account with UPI enabled. Aviraj took a sip of his coffee and asked, "Nand, before applying for an IPO, do you know how to understand how the company actually makes money?" Nand smiled sheepishly. "No, I don't. But do I really need to understand the business model? I was thinking of applying only to those IPOs that everyone seems excited about. After all, if so many people are applying, it must be a good investment, right?"
"So, where do we begin?" Nand asked. Aviraj took out a notebook. "We begin with the company itself. Question 1. What does the company actually do? If you cannot explain the business in 2 or 3 simple sentences, you probably shouldn't invest. Question 2. How does the company make money? Revenue is one thing. Profit is another. Understand who pays the company and why. Question 3. Why is the company raising money? Is the money being used to build new factories, reduce debt, expand operations, or is it mainly giving existing shareholders an opportunity to sell? So, not every IPO brings fresh money into the business? Nand asked. Exactly. Some IPOs are largely an offer for sale, where existing investors are cashing out. Question 4. Is the company growing? Look at its revenue, profits, cash flows, and return on capital over several years. One exceptional year should not impress you. Question 5. Does the company have a competitive advantage? What prevents another company from taking away its customers? Nand smiled. So I'm looking for a moat. Aviraj smiled. Precisely. Question 6. Is the valuation reasonable? A wonderful business can still become a poor investment if you pay too much. So I should compare its valuation with similar listed companies? Exactly. Question 7. What are the risks? Every DRHP contains a section called Risk Factors. Nand asked, what is DRHP? Aviraj smiled and said, it refers to Draft Red Herring Prospectus, which is a document contains company's introduction and information booklet that tells you everything about the business before asking you to invest your money. Most investors skip it. The best investors read it first. Question 8. Who runs the company? Study the promoters. Their integrity often matters more than their presentations. Question 9. What do the financial statements reveal? Are profits supported by operating cash flow? Is debt manageable? Are margins improving? Question 10.
Should I invest even if I don't receive listing gains? Nand paused. That's an unusual question. It's the most important one, Aviraj replied. If the share price doesn't rise on listing day, would you still be happy owning this business for the next 5 or 10 years?
Nand slowly closed his notebook. I think I've understood something. Applying for an IPO isn't about predicting tomorrow's share price. It's about deciding whether I want to become a long-term owner of the business. Nand sighed as he looked at the long list of things to check before investing. This seems like a lot of work before applying for an IPO. Aviraj smiled. There is one shortcut, but only if your objective is to apply for an IPO for potential listing gains rather than to become a long-term shareholder. Nand looked intrigued. What is it? The shortcut is to let experienced institutional investors, QIB, do the detailed research and then use their participation as one of the factors in your decision.
I'm simply assessing whether the IPO is likely to receive strong market demand around the time of listing. But remember one thing. It is a strategy for applying with the objective of earning potential listing gains. Nand leaned forward with curiosity. Aviraj, then tell me the complete strategy you follow while applying for an IPO. Aviraj smiled. I'll tell you my strategy, but remember one thing. It is a strategy for applying with the objective of earning potential listing gains.
Aviraj picked up his notebook. Step 1. I understand the business at a high level. I don't read every page of the DRHP, but I make sure I know what the company does, how it earns money, why it is raising money, and the biggest risks. Step 2. I check the valuation. I compare the IPO valuation with similar listed companies. If the IPO is aggressively priced without strong justification, I become cautious. Step 3. I study the grey market premium, GMP. I never treat GMP as a guarantee. It only tells me what some participants in the unofficial market currently expect. Step 4. I closely watch the subscription figures of QIB. The first category I focus on is the qualified institutional buyers, QIBs. These institutions usually conduct extensive research before investing. Strong QIB demand is a positive signal, but it is never the only reason I apply.
Step 5. I observe the retail subscription. High retail demand creates excitement, but excitement alone doesn't determine listing performance. Step 6. I check the promoters and existing shareholders. I want to know whether the IPO is primarily raising fresh capital for the business or whether existing investors are selling a large portion of their holdings. Step 7. I decide my risk. I only invest money that I can afford to have blocked until the allotment process is completed. I never borrow money just to apply for an IPO. Nand closed his notebook. I've noticed something. You never rely on just one indicator. Exactly, Aviraj replied. My decision comes from looking at all the pieces together. He took the last sip of his coffee and smiled. Successful IPO investing isn't about finding one magical shortcut. It's about following a disciplined checklist every single time. Thank you for watching this video. We hope Aviraj's IPO strategy helps you analyze every IPO with confidence, manage risk wisely, and make informed decisions, whether you're investing for listing gains or long-term wealth creation.